Hello, everybody. My name is Matthew Kessler. I've been in and around venture capital, private equity, fund of funds, and hedge funds since the mid 80s. I've worked for Guggenheim. I've worked for BlackRock. I worked for UBS, Ping, Weber, Merrill, and all of those departments. So I've seen a lot of deals. I put a lot of deals together, and obviously I've raised money for those asset classes. Marty asked me to come here today to sort of lead this discussion about venture capital. Obviously, we have three amazing participants. Val Sassi, Chief Strategy Officer from Manhattan West, Ron Davari, Executive Chairman, New Oak, welcome. And then obviously, I really need to thank David Kramer. David and I were at a cognac tasting here at Greenberg, Glusker just about a year ago. And we were just talking about family offices, and I described what Marty does with IvyFON and how it works and how, integral it is for families to really understand different asset classes. So David, thank you very much for putting this together and, championing our cause to bring Marty here today. So thank you very much. Venture capital. Let's think about some of the firms that VC invests in, have made tremendous amounts of money, have had big success in terms of $1 billion or more in terms of value. And let's sort of lay the groundwork. What is venture capital? Think about WhatsApp, Facebook, Groupon, Snap, King Digital, Alibaba, JD.com, Delivery Hero, LinkedIn, PayPal, Zoom, Amazon, DoorDash, Coinbase, right? All of those were small little firms, started in garages, all had founders, all took the next step and found possibly angel investors, took the next step and went to VC funds, took the next step and was able to make it work. So what we're going to talk about today is how all these companies came to be. But more importantly, let's just make sure we all have an understanding of how venture capital works. So I'm going to start with our host, David, and ask you a couple questions that I just thought were important in terms of, your background, what you were doing. And I think more importantly, how you and your role here at Greenberg Glusker really, I think puts together venture capital deals, helps family offices, strategizes with them, and helps them sort of move into, if they want to, venture capital. But more importantly, there are sometimes VC founders come to you and say, hey, I need strategic help, right? So we know that there's all kinds of possibilities. So when you and I were talking earlier, you said that 24 this year has been one of your busiest VC deal years. Talk about that a little bit and your background and what you are doing now with Greenberg Glusker.
Yeah, sure. Thanks. So just a slight tweak that I wouldn't say it's one of my busiest years. I think it's just been busier than the last year and a half, which were very, very slow given the the interest rate environment. This year, though, I think actually echoing off Andrew's on the M&A side, I will have closed more priced rounds by end of June than I did all of last year. We've seen some movement on the tech side and the consumer product side. I think we've seen people on both sides, both the issuer side and the investor side, having more realistic expectations on valuations. I think we've seen people pricing around and modeling around the interest rate uptick and no longer sort of pinning these deals on 2, 3, 4% rates. And I think we've seen people just sort of understanding and coming down to earth a little bit from the heyday of, let's say, 2015 and through 2020 with more realistic expectations of where the market is.
So let me pivot over to Vic and welcome. Thank you very much for coming today. He is the Chief Strategy Officer over at Manhattan West. I mean, your background in tech is so impressive in terms of not only Manhattan West being a wealth management firm, but you've been in and around private equity and venture capital and real estate. You're leading the entire digital asset effort over at Manhattan West. You've done 100+ deals, so you really have sort of a nice feel for the marketplace. So we're glad to have you here. Talk a little bit about I would think this sort of Y Combinator, these startup accelerators, why are they so important for the founders and why are they important for possible future family offices that do the investing in these young companies?
Yeah, sure. So thanks for having me. So Y Combinator or YC holds a special place in Silicon Valley because it has birthed so many incredible companies. Coinbase, Airbnb. I mean, a number of ones that Instacart, I believe, went through YC.
Yeah.
Started by Paul Graham and his wife, Jessica Livingston.
Livingston, and you got Robert Tappan Morris, then you got Trevor Blackwell.
Right. So they have, I mean, they were effectively one of the first accelerators and by far now the most prominent. And, they run this sort of fund. And basically, their business model is at the time, for a long time, they would give $125,000 for 7% equity. That has now come up to almost like $500,000. And equity is still about 7%. And it's a little convoluted, but a very rudimentary understanding is $500K for about 7%. So, I mean, look, there are a plethora of other accelerators, incubators, this, that, and the other. There are ones that are generalist or sector specific, but YC is the cream of the crop. I mean, they like to claim, and I'm sure it's true, that they have a lower acceptance rate than Harvard undergrad and, everything else. And yeah, and during the pandemic, they had increased their batch size. They do 2 batches a year. It went from being like the first batch, I should say, is what was like 2007, 2008, and Reddit was actually part of it. So Alexis Ohanian went through it. Sam Altman, who would later become the head of Y Combinator and is now obviously CEO of OpenAI, was in that initial class. And I believe there were only 7 or 8 companies. It ballooned to about 100 or 150, and that kind of kept that size per batch. And then in the pandemic, because you couldn't miss if you were investing in anything, I think the batches got up to like a couple hundred. And they have since right sized, and they got rid of sort of growth fund. But anyway, for the purpose of this question, they are sort of, without a doubt, one of the best credentials to have for a really early stage company that has sort of gone through their accelerator. Other thing I'll say is that if you're a repeat founder or if you already have a good network with fundraising, you don't need to go and give up 7% of your company to go through Y Combinator. So it's not the only sort of hallmark of a great early stage company, but it's certainly one of them.
Fantastic. Thank you. And Ron, welcome. You're executive chairman, obviously, of New Oak. New Oak, just quick background, solutions and advisory platform, offers clients analytics for a broad class of assets. And more importantly, does forensic analysis of securities and collateral loans. But that's sort of half the story. Ron has spent a tremendous amount of time in tech. He was part of Orbis Pay, which provides on-demand pay. He was part of Future Pay, which is a digital revolving credit solution company. He was part of FinTech Tech, actually FinPlus Tech, so get that right, which specialized in AI systems and development. So you've got this nice, robust background, very much like Vic does in tech. So my question to you is, let's just sort of talk about asset allocation, VC funds, access to venture capital. How does a family office that's in this room today or watching us, through the online, how do they begin to sort of venture into this asset class? How do they knock on the right doors? And what's the proper way for a family office to make an allocation?
Thank you for asking, and thank you for the opportunity to speak. I think I am an accidental venture capitalist, if you want to call it, after being an entrepreneur at BlackRock, pretty much in the financial world, and prior to that, at McDonnell Douglas, being an R&D developer. So by the very nature, you always are investing, whether you're investing your time, your firm money, or your own personal money. So when I look at the venture, you cannot be an accidental tourist in this. You either have to be in it because it's really a full-time attention, and you also need to have a process, because no single investment is going to give you the return you're looking for, unless it's a adjacent business that you know very well. Let's say you're in oil and gas, you're pumping oil in Texas, and you're finding another related tech that would potentially clean that stuff for you, and you're going to invest in it. So you pick it for a whole different reason than going into a VC. I actually mathematically believe VC is, first you need to figure out if it's fit for you. Do you really want to own it? And asset allocation is one of the areas that we definitely, as a OCIO, teach or try to get to the pension funds, or even a family office needs to have a real plan. How do they want to build their portfolio and where they're going with it? The reality is that early startups you're going to have a certain number of them go to zero and a certain others. So do you really do a single investing or do you want to go, broader? So I found that I need to have a theme personally. So I went, hog wild in 2008 to start bringing sort of companies together from really startup and it started going from there. So bottom line is, go ahead.
No, I was just gonna say, I'm gonna just transition quickly over to David to pick up on this is, family offices can also be angel investors. Do you think that a family office should be an angel investor, or do you think family offices, based on their asset allocation, should be going into VC funds?
It depends on what people's goals are long term. I think Angels obviously has a longer hold time, right? It's a longer investment horizon, so more liquid. Both of them are fairly liquid, but certainly Angels earlier on. So people just have to be comfortable with that money not being touchable for a bit. People like the idea of being angel investors. We heard from someone yesterday, from Jessie Draper. She does a lot of, I think, angel investing. They're the first outside capital, and that carries a certain a strategic advantage. It endears you in a certain way to founders. It's usually more often than not will give you the opportunity to participate in the first price round. Let's say it's an A or what have you. So I think there are strategic benefits there, but everyone has a different risk tolerance and investment profile.
So Vic, let me pivot back over to you. I mean, angel investor to me says passive, right? They're just passive investors. They're putting up capital. They have no experience. They're not operators. They can't help you raise additional money. They're not very good in management. They don't understand, alternative investments. They're just putting up dough, right? They're just putting up money. That's why, I think family offices moving into a venture capital fund or a venture capital situation is so much more important for a young family office. Generation 2, Generation 3, they inherited money, they've made money. Now they know VC should be part of an overall, asset allocation. Talk a little bit about why VC funds are the appropriate place for a family office, or maybe not.
Yeah, no, I think I generally agree with that. I would say it's sort of like a walk, learn to walk and then run. I think, look, loss ratios in venture it's the riskiest part of the spectrum for a reason, because loss ratios are, 60 to 70%, or maybe it's like 50% and then, 20% you'll get your money back with a 1x or something. And so, for these principals that are taking over, the wealth or running the family office and looking to allocate to venture, I don't know if they can sort of go back and justify to, the family or the rest of the family office, like, oh, we're taking a bath on some of these, but don't worry, one of these, we're swinging for the fences. One of these is going to sort of like return our fund. I think it can be really hard. I think adverse selection is really hard to sort of qualify, but you should just assume that if it's coming to a family office, it's probably been passed on by literally hundreds of other much more institutional or professional venture funds.
Take that one more step. So I just want to make sure every family office heard that.
Right. I mean, I don't know how to say this. I appreciate being here. This may be the last time I'm here, but family offices are traditionally known as, some of the more dumber forms of capital, unless they have experience in allocating or experience in the asset class. But certainly from the venture side, if you're, a fund one, or if you're looking for capital and, something is wildly unproven, you're not going to Sandhill Road and expecting a term sheet from Andreessen Horowitz or Sequoia. You're going to who knows the least about this asset class, but just cares about access or exposure and could maybe write the check. I'm painting with a very broad brush here, but I'm just saying, it has that stigma for a reason. Now, for that reason, and again, I'm not trying to say all family offices operate like this, but for the ones that have never done venture before, that's why a much more risk-adjusted way to enter this asset class is to invest in funds to folks that have had, the experience, the expertise, the track record, that know how to diligence, that know, what they like and what they don't like. And from there, you can kind of learn, okay, maybe this is how I should be doing this. You'll see, you'll get all these LP updates, you'll go to their AGMs and everything. And slowly, I think you can build your own practice, but it takes reps and, no matter what, you might see something compelling, but chances are it is not the right fit.
Really well said. So Ron, let me switch over to you. When you and I were talking yesterday, I kind of pushed you a little bit. I said, okay, what sectors do you like? Where should a good family office be thinking today? And a couple of those that you threw out at me was technology for basically the humanity portion. You said to me, the volatility today in the market means new benchmarks for venture capital. And then you said there's some great opportunities out there because the valuations have been disrupted. So that means discount. So talk a little bit about,
Sure.
technology and volatility and this just disrupted, valuations you spoke about when you and I were chatting yesterday.
I think the opportunity set today is far bigger than ever because of where the technology is today. And the whole new areas have been opened up. AI is being one, but application of AI to renewables, to sustainability. And then you have India and Africa and Asia, one of the areas that they're hungry for capital and hungry for really new ways of doing things. The same way they adopted the cell phone faster than we did, and they adopted a lot of education. For example, AI education in India is far more adopted today than it is in the US. And they have picked it up so for that reason, I really do believe that right now, if you're underweighted this asset class of really brand new ideas going from A to Z and really making it very big, it's never been, I think it's even bigger than Bitcoin travel that you're looking at because so for that reason, you need to really think about how you're going to approach the asset class. I don't recommend you start with one and then you start learning your way into it. You really need to think, how do you want to position yourself in tech? And then, so running a venture fund, even for a family office, even you have 20, 30 million bucks to allocate, you're looking at, take a $500,000 check or $200,000 check. Look at how many investments you have to make, how many things you have to filter out. And then the other thing is that if you sponsored an investment at a very early stage, and if they're not sponsored by a venture, they're not going to get follow-up capital, they're going to die. So how are you really going to go through that? And then I had to go through that. So in that regard, I changed career. I went from really investing in the most established asset classes to the least established areas and put my entire bet on it. And you need to really think about that. That's where you want to be, and you have a 20-year, 30-year horizon.
Love that. Say that again.
20, 30-year horizon, persistent. Failure is not final. Failure is not fatal, and success is not final. You got to keep saying that.
Right.
Because by having the first investment being successful, you're just going to start developing very bad habits. You're going to actually fail a lot more than. It's better actually to fail 3-4 times with a small investment to start learning your way. So you do like I say, how do you win in poker? Double up your bet every time and you'll ultimately win. And it is a numerical thing, but at the same time, it needs to be very intentional and it needs to be programmatic. I keep saying that. You cannot go there and say, okay, it's a buffet, I'm going to pick this thing because it could be very poisonous for you. Right. So anyway, that's where I stopped. But
and that's sort of the conversation we're having of, spray your money around and pray that you've done the right thing. Right. So that's a big problem. So David, let me switch to you. We were talking about famous vintage VC years, right? 29, 87 black market, dot-com bubble, you had a financial crisis in 15, 16, cryptocurrency. There's just been so many different crashes, coronavirus. Okay, now we're going forward. It's hard to predict the next epidemic or problem. Where should, an investor think about today putting his money into VC? Is it going into, as the last group thought, in PE funds? I'm going to put my money safely into, the S&P 500 index fund. Should I dip my toe in the water? Is now the right time? I think a lot of investors are hesitant. They just don't know what to do going forward. So what do you recommend? Are we still in that pandemic mode, going back 2 or 3 years, or is it okay to get into tech?
Well, one of the few good things about being a lawyer is you don't have to make those decisions, right? You sort of let your clients dictate to you where they want to deploy, and you can of course help structure things appropriately. So I can't tell you what people should do. I could tell you what I'm seeing, though. I think Vic, you made a comment a few moments ago about if family office is dipping its toes into venture, it probably means people pass. I've definitely seen that play out, and I think smarter money, as we say, has gone the route of Andreessen has a new fund, let's throw some capital into there. Sequoia has a new, whatever, big and battle tested VC is.
How did you get into those funds, by the way?
Well, I guess it depends how much capital you have and what your last name is, right? But and things of that sort. So what I'm seeing is people being a little bit, and Andrew made a comment this earlier, trying to ride out the uncertainty a little bit and trying to figure out where things are going. So people are, I think, diversifying a little bit more. I think you have people, we talked about this last night at dinner with some people, that are the line between private equity and venture is slowly, I don't want to say eroding, but the lines are being blurred a little bit more. So people are now looking at, in general, okay, I have capital deploy. What's the bottom line on these deals? Usually that was a more private equity driven analysis, and venture was a little bit more pie in the sky. I think you have funds who are looking for more disciplined operators who are monitoring churn more regularly. And so I'm watching my high net worth individuals with family office clients making those sorts of determinations before they deploy, and not just hoping that they're investing in the next unicorn or the next Uber of X.
Right, a unicorn is $1 billion company or more.
Right, but instead looking for what's the bottom line, where's the cash flow, what's the runway, what's the prospects of profitability, and things of that nature.
Right, so just being an angel investor, you pick 10 companies, hope you get it right. That's not the prudent way to go. So Vic, let me come back to you. I'm just going to pick on 3 firms. Sequoia Capital, currently $28 billion under management. Anderson Horowitz, $35 billion under management, and Kleiner Perkins, we all know, obviously at $6 billion under management. What is it these 3 firms have in common that investors just don't realize how difficult it is to be in the business? But what is it that these 3 firms have in common, and why are they so successful in picking the next opportunity in venture capital?
Yeah, so it's a couple things. Andreessen is, relatively new of the pack. I think they were formed in 2008, 2009 when Mark and Ben came together. Sequoia and Kleiner have been, longtime stalwarts of Sandhill. Sequoia, backed Google, NVIDIA. They were one of the first checks when Jensen Huang was like leaving his former company and just saying, hey, I think I've got this idea. Don't we all wish we had access to something like that? Kleiner, the same way.
Kleiner was Google, Netscape, Sun Microsystems, Compaq, right? Their list just goes on and on.
Right. So look, they've been around forever, and their track record is incredible. Yes, they've had some missteps. Sequoia, Alfred Lin invested in FTX and all this stuff. They, he's like, yes, we took, a 70 million. I don't know what the size of their check was, but guess what? In 2021 or 2022, but they returned $6 billion to LP. So it's like, I'll take that trade all day. I think it's their track record. It's that flywheel of they continue to attract great talent, both from the investor side and then founders too. And so it's a dream, really for some of these founders to even get to go pitch the partnership at any of these storied firms, Greylock, Excel, formerly DFJ. So they're, just incredible. Now, they've changed around their structures. I think Sequoia and Andreessen have now all become RIAs because they are at this point seemingly capital agglomerators. So they are trying to amass AUM. Andreessen just came out with $7 billion across a couple of funds. And what Marty said earlier is, before up until the last, few years, all of these funds were completely access constrained because they used to be pretty focused. They knew that they can just raise a $400 million fund or 250, kind of like what Benchmark or Union Square Ventures does. They've never gone above that mark because they know they can just return that fund, 4 to 5x net at least, vintage after vintage after vintage. These others are sort of saying look, this is also kind of an AUM game. And Andreessen now is, probably, I think $45-50 billion in AUM after 15 years in market. And it helps when you have 2 incredibly, notable and prominent founders as your at the heads of the firm. But it's.
Yeah, I was wondering if you're kind of you're on the topic, but do you folks have any concerns about the massive amounts of money? When I started in this industry 15, 20 years ago, VC funds were a few $million. Now we're talking billions of dollars. We're talking private equity groups that are publicly traded. the amount of money that's being amassed by a handful of groups kind of creates this imbalance in the marketplace. I was, and a group of people, particularly in the VC world, who are all buddies with each other, who all do group deals, who all
Dinner,
talk to each
dinner.
other.
Right.
There's this
Yeah.
echo chamber of what's great and what's not great. I'm curious about your response to kind of that situation when you have these multi-billion.
Let me actually, because I'm an outsider, I'm not a VC guy. I didn't grow up in a VC world. I came in a very fiduciary asset management world. And I knew that I cannot pitch, these companies to pension funds. They walk out of the room because why am I giving $200 million to a company that just had a pitch book and started? And we've seen that. And the reason they succeed is, they play the game by being able to be supported, keep putting enough money so that they lead in that. So they first pick a sector and they pick, a couple of guys. And what actually I take an exception on is that often enough, the founders that they pick are not necessarily what I consider very seasoned people. They're going with, your school buddies, if you want to call it that way. There is a definite, culture to invest in your buddies going on. And that's why I'm saying if you're in the wine investing, for example, yeah, I can always go to Burgundy or Bordeaux and pick the Grand Cru and I win. There is no question about it. And I think I view the investing in VC as very similar. If you really want to find out a special thing that fits your portfolio, a lot of those ideas don't even make it because a lot of founders are, if they're not from that class of people, they didn't go to Wharton or they're not even going to get the first look at. So in that regard, I feel like if you're looking for opportunities but you need to be persistent, you go the route of, like for me, it was
Fun.
Yeah, fun. You need to have fun with it. That's really the idea.
I just want to intersperse a couple of comments.
Sure.
I think that the RIAs that are set up are not venture capital RIAs. I think that the Anderson Horowitz is an asset manager who's managing a lot of crypto, right?
Correct.
They have $35 billion in management right now.
But I think some of it is in managing a crypto fund.
Don't know.
Yeah,
I don't think that they're doing 35 billion of allocations to early stage. They're not. right?
No, they are. Yeah, 100%.
That's their business.
Yeah, what do you mean?
They're retail, but they're going after like retail wealth management.
Right, exactly.
Business. And not all of that is going into the same strategy.
Right, it's not all going into venture. Right.
This is the first time through Allocate, Samir Kaji runs this, used to be at First Republic and SVB, that they've put their funds through wealth managers, but I would say 90% of their AUM is split across their funds. They've been around for 15 years. I mean,
Right,
they
you
have
say that they're allocating 35 billion into venture capital.
a bio fund, a crypto fund, a growth fund,
Crypto
early
fund,
stage
right.
gaming, AI infrastructure. They just restructured it, but these are all, they are,
But even their wealth management arms that they're building for internal capital for external.
Yeah, I mean, it's part of its growth, which is not, but one of the things that
I think
I just want to get back to Jack's point, which is that with so back in the day, the old theory was that you would invest in one round and then other VCs would come in and invest in the next round, and that would cause price discovery or value discovery, right? And that actually has been pushed to the background because so many of these VCs invest every round, right? So you really can't, get price discovery or what the real value of something is, which is why so many of these companies, when they go public, are dogs, right? Which is terrible.
Guys, you agree with what I'm already saying?
do you mean to defend ownership? Because sometimes you reserve a third of your fund for follow-ons.
Correct. And because some of these funds are so big, they can do more than one follow-on round. They can do multiple follow-on rounds. Right?
That's how, this is how, right.
That's how it works.
Right, I'm saying philosophically, that's been a change in venture capital, didn't exist in the past, right? You're probably too young to remember.
Got you.
But it's something that has changed. And this is why a lot of these companies, when they finally go public, there's no more VIG, there's nothing, there's not very little gain on that once they get into the public markets. Right, so the whole deal flow all the way through is private.
Wait, Vic, I know you're
I
Joe.
vehemently I don't disagree, but a lot of growth in public companies has come after
From the
they've,
VC.
after IPO, which is why during the pandemic, actually Sequoia restructured, they became an RIA, and they actually restructured the way that they run their funds through, it's almost like a permanent capital vehicle, through like a master and then a sub funds, because they wanted to hold on to those stakes, like in Block or Square, because those companies have continued to do really well after they went public. Obviously, as a fiduciary, your goal or your role is to return either the shares or the capital once you get that exit or liquidity. That's the same thing with Shopify.
I think the terminology difference. RIA, managing fiduciary assets for individuals and their family. You're an allocator, you can't allocate to your own funds. So if you're controlling the
But
clients.
they're maintaining public stakes.
No. If you're a fund manager, you're also an RIA, but you're an institutional RIA, like BlackRock doesn't handle, they have a different division that handles high net worth management, that they allocate. They're not calling the guy saying, I'm going to put your money into this fund. So you need to have. Not only they're not brokers, they're not, the RIA division, the managed separate managed account, doesn't issue funds. So if you're in the fund, like, I am a fund manager, I create a fund, I allocate and I raise LPs, right? I'm not fiduciary with respect to the investor. I'm fiduciary with respect to the fund, right? So whereas I think that's the difference. All of these guys are finding, how do I actually get people, give me X amount, so I allocate. So across multiple funds, and that's a whole different business than being a venture fund. Being a fund is not an RIA business, but you have to register as an RIA,
Right.
Because if you're above 100 million, your individual
Is that the requirement in California?
everywhere. It's
Federal.
a SEC requirement. It's a federal requirement. So you cannot mix the two. I cannot take somebody's money, put it in my fund, because I have control over that. So there's a conflict.
Yeah.
I haven't.
Right. I was like,
Right.
well,
Oh, no, you gotta disclose. I just got a guy who got zapped for doing that without disclosing the conflict. Oh, you have to disclose it. Yeah.
I'm not an investment advisor act guy, so I'm not the right person here. But if I can, I want to go back to Jack's question, which is about, I think, in the sense of, with all this capital out there, are people effectively making bad deals or deploying capital into spaces that they probably shouldn't be?
Yeah.
Right.
Well, I don't know they're making bad deals. It's not that you can't discover if the deals are bad for a while.
Or on the other hand, and you have that, but you also have opportunities that are getting missed because it's the same group of people
Sure.
who are talking amongst themselves that are making the same decisions, where there's opportunities out there because it's a different sector, a different space that aren't actually part of the conversation.
And I just want to make an addendum to this statement, which is that, and this is brought up earlier, which is that these companies that are RAs are phenomenal platforms. I mean, they really have fantastic platforms of outreach into the industries that are going to buy their companies, which is why they're so successful.
But if I want to get into Sequoia, I have $50 million burning a hole in my pocket. If I don't know somebody at Sequoia, if I don't have a relationship with
You
Sequoia,
don't get
if I haven't
allocation.
been in one of their prior funds, I don't know one of their people. That's called a pre-existing relationship. I have no relationship with Sequoia. It could take years to collect that relationship. So so let me hang on one second. So how does somebody, and let me just go right down the row, start with you, David. How would that family office with $50 to $100 million in his pocket get into Sequoia, Anderson, or Kleiner?
But
What's the
David
way to
never
do
addressed
it?
the prior question.
Yeah, I just wanted to actually go back if
Oh,
I can.
sorry,
No, that's
sorry.
okay.
But it's along the same lines. We're
Yeah, it is.
access.
Well, I was actually going to the more of the bad deal comment, because without mentioning any names, I had a very large client that was a tremendous beneficiary of that fact pattern, which was they had no business getting the size of the check they got, but it was a hot industry. And one of the big names that just came up, again, I don't want to go into specifics, said, you're a female founder group, you've had a couple of successful exits, you have Wharton and Yale on your pedigree. Great, here's a check, a massive check for an a massive, massive check. And you know what? No one complained. I think, you're setting yourself up for potentially down the road, but that's not what founders are, front and center when they're getting a check from a big player in the space. So I've seen it play out. The verdict is still out on how it unfolds. Whether it's a bad investment, we won't know. But I think the potentiality for that is really happening. Now, on the flip side, to Marty's other point, these are very disciplined folks, and they're much smarter than me. And they've done this a lot longer than I have, and they've deployed a lot more capital than deal flow I've seen. So I'm not betting against them, but I think it's a very real reality undercutting the market, underlying the market.
In some respects, I favor seasoned VCs because when they look at a deal, they know where it's going, they know its life cycle.
Correct.
Whereas those who are novices, you see a lot of guys who
Sure.
just came out of, whatever the,
Y Combinator.
Y Combinator.
They don't know the logical life cycle of all those ventures that they're looking at, right?
Well, YC's track record is pretty
I'm
impressive
talking
too.
about a lot of VCs come out of Y Combinator who sold their businesses. And they're like, oh, I have Y Combinator deal flow now, right? And it's not so easy.
I think if you want to go the old fashioned way, you go with the accelerators and Y Combinators, right? Because they certainly would invite you in to write a check along with them. As a matter of fact, that's for their pitch. When you win the competition, you see, Tim, for example, Draker, he goes around, he's like a traveling salesman. That's all he does. Sorry about that, but all he does is essentially set up, a educational program for startups, the founders. So that is where really you're going to get a lot of hungry founders trying to figure out how the heck do I go from I'm bored, I'm sitting at JP Morgan's desk, I'm spending all these hours, but I'm not going to get there. I'm going to start with a pitchfork. So if that's that's where a lot of good ideas are coming from. So I think you would take 5, 6 accelerators, you get close with them, you go through a lot of their presentations, and then that's the way it's fun.
There's a woman out of Silicon Valley who has a fantastic track record who is involved.
That's what I do. I go to a lot of fucking startup meetings, just listen to these, and it says, oh, this guy has now an AI application that fits my other portfolio. Boom, done. Here's $200,000 and I give you a scalability by giving you technology. I put my LLM guy on the side. These are, not only I give him a little bit of money, but I also give him, cheap technology development.
Right.
So
Vic, let me go back to you. So Sequoia, Anderson, let's say Kleiner, I want in. I've got $100 million in my family office. What are some of the steps, as Ron was alluding to get into these funds or at least get close?
Yeah. So again, those are, Sequoia and Kleiner, you basically have no chance for the most part. There's a new organization called Allocate, which is basically kind of like how Moonfair was for PE, and there's Case and I Capital allowing access to, tier 1 names and alts to RIAs.
They're like feeder funds.
They're like feeder funds.
yeah,
Right. And so this guy, the founder, CEO, Samir Kaji was, used to bank a lot of these funds when he was at SVB for, 15 years, then First Republic for 10. He saw these firms sort of grow. So he's like, oh, let me sort of broker access. So that's one way. The other thing I'll say is, look, yes, probably 80% of the returns in venture, probably maybe even higher, accrue to the top 10% of the firms. But there are other great firms too, Greylock, Excel, this, that, and the other. And there are also, the asset class has grown. And maybe to answer one of the things that you had brought up previously is, a few years ago, we saw our first $1 trillion company. Now we have $2 and $3 trillion companies. So
would you name them for the group?
Microsoft, Apple, Google, NVIDIA, Facebook is getting close. And Meta, I mean, now, when you're underwriting an early stage company, you're like, okay, you would never say this could be $1 trillion company. And yes, you have to ride it out, post IPO and everything. But the ceiling on how big companies can get an exit for is, continues to go up. And so that's why if you can underwrite to larger and larger outcomes, you need more and more capital, especially if these companies stay private longer. And so, to defend your ownership and to keep going and also just take a lot more shots on goal. And so that's why I think you're right. A lot of these firms in the early 2000s and even the 90s were one and done. They didn't have a bunch of reserves. These were much smaller. Everything was a lot smaller. And now it's look, you need capital for, you need to take a lot of shots on goal. You need a bunch of reserves to defend your ownership. So anyway.
No, really great. So David, let me come back to you. You and I were chatting yesterday.
We have audience questions?
Oh, we do? Go ahead.
Yes, so here's from Rob Collarina. What is the preferred ownership range by GP management
David?
on the fund?
Ooh,
I don't know. Maybe that might be something that you guys want to speak to. I could tell you what I see.
Are we talking about real money or just a split? Is it money?
Historically, I think it's been 2 to 10% in a fund.
The GP, the actual GP.
You're talking about the carry management fee or the actual ownership on the actual deal? I thought it was the ownership question.
What's the preferred ownership range by GP management? I guess that's by.
The management, this is by management.
In the GP, maybe in the fund? Or
That's
maybe,
fun.
maybe it's not right now,
No,
ownership.
if it's a fund, I mean, you're
Typical.
typically 20,
Around
Yeah,
this
20%. It's a 220 structure.
No, I understand, but I'm talking about ownership in the fund. So in other words, how much?
Fund
money-
or the company?
How much money the GP, how much did the GP?
Yeah, 1 to 2% commitment.
How much?
It's 1%.
1%, okay.
Yeah,
The latest fee structure for VC funds in Asia, GPs now starts introducing upfront management fee charges for the duration of the investment period.
yes, you are.
Is this the same as in outside?
No, so those are what is called a continuation fund. So what they do is there's a pre-IPO. So they think they're going to go in 3 years, 4 years. So they invest, they collect, effectively they're brokering the deal. They get an allocation of 200 million. They say, okay, we're going to charge an asset management fee of 1% a year. So it's 5%. We're going to collect that upfront. It's called an SPV deals, right? And it's a single company fund typically. By the way, if you're interested, we have about 5 billion of that with allocation. These are companies that come out of Blackstones of the world funds, and they go in and you get a continuation right. And those are good, but they're not being brokered. You set up an asset management vehicle, and all your job is to make sure that the actual GP that it was Blackstone, whatever, is doing a good job, and you get an allocation because as an individual, you're not going to get it. But if I bring in 200 million, they take it. Right.
Marty, do you have a second question from the group?
No, that was the second question.
That was the second question. Okay, so
We
let
got
me.
about 5 minutes.
5 minutes, great. So let's just talk about asset allocation in terms of, location, right? So we know that Silicon Valley, we know that Los Angeles, we know that Miami, we know the corridor between, say, New York and Boston is hot, right? Those are the areas. Again, let's talk about these family offices that are listening today, and part of it, how again should they gain access? I mean, is it stay in this, great area in Southern California and think about, okay, conferences, one-on-ones, go to as many meetings as possible. And maybe what's the next corridor? But more importantly, these locations continue to breed, great firms. Obviously, Silicon Valley coming down, through here in Venice Beach and over to Miami and up through the corridor, New York, Boston. How do we get access? I think that's the question I'm really looking for is, again, access and location. How does somebody do that? So Vic, I'll start with you if you don't mind.
I think if you haven't allocated to venture before, I think investing in funds is a great way to sort of get your feet wet. I would not recommend doing directs until you know what you're doing, or until you've seen a bunch of deals, until you have your diligence criteria or rubric sort of, really hammered out. And look, want to modify what I said. I didn't mean to say that family offices are dumb money. I mean, like, know your strengths, know where, you know something more than the market. I mean, look, private markets and venture, I mean, it's like predicated on not insider trading, but on information asymmetry. And so if you possess something, if if you're a big manufacturing company or clothing or textiles or whatever, and you see a deal that is offering, some AI or computer vision in the factory floor or something, it's like, not only can you go pilot that, but there are probably 40 people immediately in your, in your orbit that can go and actually help diligence that. If it's, some God knows what gaming or, whatever deal, and you see it, and, then you should kind of, sort of like, you should be a little more wary, is what I'm saying. So I think funds is a great way to sort of start. And yeah.
Yep. And again, let's just talk regional, maybe your favorite region you like, whether it is Miami or California or the corridor, and then access.
I personally like New York, and that's probably where you're not thinking, but you get a lot of people in the fintech world coming out of that area. Actually, I prefer fintech people out of New York better than Silicon Valley, because they're really finance going into tech, whereas the techies going into finance is always lead to disaster. And I've seen it. I've seen it a lot. I'd rather get somebody, frankly, from my alma mater, BlackRock, or Morgan Stanley, or somebody else who's managed really pension funds and whatever, or high net worth, and go in there, rather than somebody who just finished their Stanford degree and now they want to apply technology to do something. So that's number one. You figure out what industry you're looking at. If you're looking at let's say renewables. Where do you go for renewables?
Good point.
Right, I mean, you don't go, I go to wine country if I'm investing in wine. If I'm going to fintech when I'm going to
Fine.
media. Where are you going for media? Media and entertainment, you better come to LA. San Francisco is not the place, in my view.
Yep, yep. So
I'm seeing a lot more activity out of Austin, obviously, the last
Oh,
5 years. Austin's been a real hot area. Founders have moved there because of, whether COVID's allowed people to move or just, people getting fed up with California. New York, I agree, has become a real hotbed the last like 7 or 8 years in particular. The startup scene, and like for whatever reason, the FIDI areas and the fashion district have picked up a lot.
Yeah.
I totally agree with Vic, and I said this already on sort of the access issue. I think if you don't know what you're doing, leave it to the professionals to do it because they know what they're doing, and there's a reason that they have a great track record.
So Vic, let me come back to you, and I know Marty, we're running out of time. So let's just talk about the venture arms of some of these really, robust firms. The venture arm of, say, CAA, right down the street, Apple, Amazon, Google, Alibaba. Talk about their venture arms and what's interesting that I think you should just share with the group, because a lot of people don't know those companies actually have venture arms.
Yeah, sure. So I actually started post MBA my career in venture at a corporate venture fund, and nearly all companies, after Clayton Christensen's books, are now thinking about disruption and innovation, and so that's what sort of spawned having a venture arm, and kind of sometimes they'll do it in conjunction with their corporate development teams. I sound like such a not a nice person. Corporate VC equally has a negative stigma as dumb money. And I say that because, look, for most of these companies, especially the larger you get, you can have a 10 or 100x winner on an investment. It doesn't move the needle at all on that company's balance sheet. And so really what they care about is their strategic return. So it's like, are we just going to sort of spray and pray and look at a sector that could, so we just have market intel on what's coming around the corner, or are these potential future acquisition opportunities? Not to mention, because it's not purely financially returns focused, your whole deal process can kind of get muddled, not to mention the way that, there's no traditional investment committee. It's like if the CEO wants, met somebody, at this conference and he really likes a deal, guess what? You can hate that deal as part of the IC, but it's going through. And so that traditionally doesn't happen at real general partnerships where everybody has carry, everybody has real incentives. And that's a much, in my opinion, much better way to function. And also corporate venture capitals for the most part, I think last I checked, it was probably 80% of them don't even have a carry pool. So that's the real carrot in, for a lot of our 2 and 20 funds.
Right, as an employee or being part of it, or an ESOP or your pension plan, it's the carry. So Ron, same question. Let's just talk venture arms.
Yeah, actually, it's very important. It's, what is the purpose of that venture arm and how does it match up with the corporate? So I've actually advised a couple of large corporate entities that they create a venture arm that is outside and is for profit, and they're trying to team up with other groups. So the decision process is not affected by the internal decision maker. They're just taking some of their specific R&Ds and presenting, like LG Nova, for example, from LG, is doing a phenomenal job of going to sustainability in Africa, where it has nothing to do with, the corporate, it's more of a corporate mission rather than a corporate return pattern. So we're seeing that in sustainability, that is becoming a very, very big way for companies to really advance the technology and get the credit for it without really worry about, and those ventures, they do provide carry through their partners, because otherwise they're not going to get the best talent. There's no way.
David,
Yeah.
last comment, and I think Marty wants to take the day.
I'll keep this very brief. I think for a lot of these businesses, and I just did a deal, one of these types of deals, it's almost, some of these companies, especially the publicly traded companies, have massive amount of cash on the balance sheets. And this is an opportunity for them to offload some of that capital, whether it's a strategic partner, almost like a marketing spend of some sort. And I think that you're seeing, if some of them hit, great, but I don't think these corporate arms are looking at these necessarily as, oh my God, we need to win on these to help grow our cash. I think it's a way to sort of put cash to work in an area that makes sense for them and their core business.
Really great.
That's sort of what I've seen.
Very nice. Gentlemen, thank you. It was a pleasure working with you. Marty, thank you. Greenberg, Glusker, thank you. And we appreciate your advice.
Your call.
I know, yeah.
Great job.
Thank you.